Okay, welcome everyone. Thank you for joining us in WealthCounsel's virtual classroom. Today we have James G. Blaze leading us through estate planning under the new and proposed tax laws, focusing on the Grantor Trust rules. My name is Monica Comfort and I'll be your moderator. Let me take 1 minute to show you about WealthCounsel membership. We provide thought leadership and continuing legal education, all included in your membership, including articles and blogs on timely topics. We offer world-class drafting software in Wealth Docs, Business Docs, and our trust administration solution, Wealth Tracks. We add new content regularly, which includes input from our member community. So you can think of this as over 4,000 fellow attorneys helping you contribute to the value of your document drafting system. And that community helps you build relationships, get helpful answers and advice, and network and make new connections. And you can share your own experiences. We're also partners with Elder Counsel, which is the premier community of elder law and special needs attorneys. Another benefit is that our members receive the WealthCounsel Quarterly magazine. You can see some of the past themes, such as keeping it simple, asset protection, and digital estate planning and administration. And if you're not a WealthCounsel member yet, you can subscribe. You need to go to wealthcounsel.com, and at the bottom of the homepage, you'll see a Get It button, and you can receive a digital edition of the magazine. While you're on wealthcounsel.com, check out the Resource Center. We have lots of other articles, blogs, and other resources on there. And under the Education tab, you can check out our education calendar. And now to introduce our speaker today, James Blaze is principal of Blaze & Associates, LLC, a St. Louis, Missouri law firm, practicing primarily in the areas of estate and tax planning. Jim has been an adjunct professor at the St. Louis University School of Law and at Villanova University School of Law. He is a frequent presenter at Tax and Estate Planning Institutes. And Jim is the author of the 2020 book, Estate Planning for IRAs and 401ks, the updated version of which for this year is part of your materials today on the Event Hub. And he also wrote the 2017 book, Optimum Estate Planning. Jim, thank you so much for being here.
Glad to be here again. I enjoy very much speaking to this audience. I was mentioning to Monica before we went on that she said a past professor, and that's because I've become much more interested in teaching attorneys than law students, because anyone who's taught law school knows that you get maybe a few people in your class that really care about your subject, but most of them are just more concerned about getting their A and moving on, and kind of lost interest in that. And then most of the students never even go into estate planning, so you're kind of teaching for no reason. So I enjoy teaching these classes. And also, for those of you who have been here before, you know that I'm extremely passionate about this area of the law. And the reason I went to got my master's in tax and went into this area is because of all what I perceive as unfair statutes and laws that are passed by Congress and sometimes in states. And so my goal is always, when Congress passes an unfair law, to figure out ways around it for our clients. And nothing could be more true than the Secure Act, which is going to be our primary focus today, as well as the provisions of the latest round of the Build Back Better Act. So that's the one that just got introduced a couple weeks ago today. And so that's the one we're kind of working on. At the end of the program, I'm going to talk about all the other proposals this year in Congress, because some of those may be relevant, because Senator Manchin, I know, said, for example, it's nice that the House will pass this Build Back Better Act, but well, we're not necessarily going to be limited to it. So that means there are an awful lot of provisions that were in the Senate earlier this year, and some of these may be put into the final version, which will go to the conference committee. Let me just give a real quick example of why I'm so passionate about this area. So one of the provisions that's in the Build Back Better Act imposes a 5% surtax on people that make, and this includes married couples, family jointly, $10 million or more a year. And there's an additional 3% surtax if you make $25 million or more a year. And again, that for some reason, that law is for single people and also for married filing jointly. I'm not really sure. It doesn't seem fair to me, but that's the way the law is written right now. Well, at first blush, you go, well, Jim, why does that bother you, that law bother you so much? How many clients do we have that make $10 million a year or $25 million a year in income? And I would agree with that. But as usual, that's not the problem in estate planning. In estate planning, we are hired primarily to draft trusts. And for whatever reason, once again, the trust rule, rather than being 10 million or 25 million, the trust rule is only 200,000. So $10 million, okay, is 50 times more than 200,000. And as you know, the same thing goes with the regular income tax rates on trust. You get into the maximum bracket at just $13,050 of income. Whereas the individuals, you have to have 40 to 50 times that level of income before they're in the maximum bracket. So what's happening, and by the way, I just published an article today. It's on a publication called Financial Advisor Magazine. It's free and it's on live. I think it's famag.com. And it's live right now. And that article is going to refer to a lot of things we talk about today. So the article gets into this whole point about what seems to be happening, whether it's intentional or not. Okay, what seems to be happening with Congress that they are discouraging the use of trust in estate planning. And why is that? Okay, let's take now the combination of the Secure Act, which everyone in this audience knows, means that after the account, let's just talk about an IRA, after the IRA owner dies, the income, the IRA must be paid out in 10 years. And by the way, if the trust is not drafted correctly, it's actually 5 years. It's not an automatic 10 years, and we're going to get into that. Another thing too, by the way, too, there's a book that's in the materials that I make available for free. That book I refer to there in the lower left-hand corner of the screen, it's a 90-page book on everything we're talking about today, and it's available for free. And you just click on those links, or if you can't find them, go to my website, which I'll give at the end, and you can click on that link for free. What's happening is that with the Secure Act and the fact that an IRA has to be paid out now over 5 or 10 years after a person's death, and now we have these 40 to 50 times lower tax brackets for trusts than for individuals. Well, just think about the logic of that. So let's say, for example, I have a client has a $2 million IRA, okay, and pays it to a trust for his son, okay, after death. Well, by definition, we know that at a minimum, $200,000 has to come out per year. And the amount is actually going to be more than that because the IRA will grow and it will compound during that period. But assuming you had no other income, there's $200,000 right there. And then if you add in other income of the trust, let's say there's another 100 grand. Now we're at 300 grand of income, okay? And we're well into the 5% surtax already. Okay, and this is what we're talking about today. As you guys know, this is not an unusual situation. You have a lot of clients that have $4 and $8 and $10 million IRAs, and they're now going to have to come out of that short period. Well, that was bad enough. And this was the last talk I gave. That was bad enough when Congress didn't grandfather our clients at all on that. But now they're adding in on top of that, on top of the high income tax rates on trust, they're going to add in a surtax, which in most cases, if your client has any kind of a significant IRA, that trust is going to have to pay that surtax too, because the level is only 200 grand. 200 grand of income. And again, a $2 million IRA, that's a minimum 200 grand a year right there. So now we got another 5% surtax, and obviously in very large IRAs, we could get into the 8% surtax. So that's what bothers me, because what's happening then is that a lot of people say, well, I don't want to use a trust then for my children. I'll pay those IRAs outright to my children, or I'll pay them outright to my spouse. Okay. Well, what's wrong with that? Well, if you pay it outright to the spouse, there's a couple things wrong with that. One of them, but the main thing, number one, it's all subject to potential lawsuits and rights of a new spouse. But number two, even if you assume the portability election, which you can't assume, because the spouse could remarry, you can't assume the availability of portability election. A very important point you got to remember is that if you pay it outright and you rely on portability to get your estate tax exemption, the spouse does not get your generation skipping tax exemption. So real simply put, if I had a 6 million assets right now in each spouse's name, and I paid the 6 million, my 6 million, including my IRAs, outright to my spouse. My spouse has 12, but we get portability, right? So we're okay. That's true, but most of the time, if you have a client, a couple that has $12 million of assets, you're going to be doing some form of generation skipping planning. In other words, have those assets passed in trust for the kids and maybe even more remote descendants, maybe even a dynasty trust. Well, the problem is if you rely on that, so you pay the IRA outright to the spouse, you don't get the deceased spouse's generation skipping exemption, and that's arguably malpractice. Okay, you just cut the exemption from 12 million to 6. See what I'm getting at? And the other 6 million will be in the kids' estate. So we don't like that as estate planning attorneys. So the idea, the goal of this presentation, the article I wrote today, this book that's referenced there is how can we have our cake and eat it too? How can we pay IRAs and other assets to trust, protect them not only from state taxes and generation skipping taxes, but also from lawsuits, rights of a divorced spouse, rights of a new spouse in case of my surviving spouse, et cetera. That's the goal, and that can be done. So that's the purpose of this article I wrote today, the book I just published yesterday, and this presentation today. Because how do you do that? And one more thing I want to mention real quickly is what I do in this free book is the first third of the book is really written for your clients and advisors. They can read this and they can kind of totally follow what we're talking about today. But the last 2/3 of the book, the very last chapter, is just for you guys. It's for estate planning attorneys. And the first half of that chapter basically is spent teaching. So I'm kind of teaching you all the laws, tax laws that underlie this plan. Okay, because if you don't first learn all that, you'll never really understand. If you get any kind of situation that's slightly different than the norm, you won't be able to follow it because all Jim Blaze talked about was this one fact pattern. So you teach the law, and then the second half of that last chapter is all my forms. So all my forms, and by the way, I update these. You always look at my website. I'm always updating them if there's any changes in the law. But everything that we draft in estate planning, for our clients is in this book. Okay, so what I encourage you to do is read it, read the explanation, read the forms. If you have any questions, just email me and ask me about it. Okay, don't just not do it because I'm not totally following it. So that's my goal. Why I'm here today is to teach so you can. I just told a client today, it's great that I can help you, and their daughter was sitting right there. It's great that I just helped your daughter, but what about all the other sons and daughters throughout the country? Okay, we have to be able to respond when Congress does these, to my opinion, grossly unfair laws, and to tax trust, again, with an exemption level, a maximum income level, and it's basically 50 times lower than for individuals. All right, so now you got a little bit of background, and you know where to look to for additional material. So a lot of this, I'm just going to be kind of repeating what I just said in a few sentences there. But under the Secure Act, which again, most of you know was passed at the end of 2019, the general maximum deferral period after the account owner is dead, and I'll probably just say IRA to shorten this, is 10 years if the amounts are paid to what I call an accumulation trust. And by the way, again, if the trust isn't drafted properly, that rule is 5 years. It's not an automatic 10 years. Okay. Why is that relevant? So if you pay it to an accumulation trust, you can only defer 10 years. So again, that could be a lot of income. So if you're talking about just a $2 million IRA, that's 200 grand a year right there. And again, you're already moving into the surtax areas. Okay. It wasn't bad enough for trust. Now we're going to impose a surtax. And again, I'm repeating this, but before this bill, from a couple of weeks ago, it wasn't as great an issue, but now it is because most IRAs are fairly significant, and you're going to move into these penalty areas. Okay, so the Secure Act, in combination with the Build Back Better Act version 2, is what's causing the problem. It's a combination of those both. So I mentioned again, the trust be properly drafted to get 10 years. That's at page 61 of the book. Okay, I'm try to refer to page references when I can, but there's also a table of contents of the book. So as we already talked about, slide 1, accumulation trusts are favored in estate planning because they result in asset protection, lawsuit protection, and divorce protection for our clients. And that's why they're there. Clients love all of that. That's why we're there. Otherwise, they would just do a simple will and just say having outright to my spouse, otherwise to my kids. Okay, they don't really need us. But accumulation trusts are in general disfavor, however, because they're subject to the maximum federal income tax rate at income levels of only $13,050. And again, I will keep repeating this, but that just gets to the point, by the way, that law went into effect now 35 years ago. Okay, 1986 is when that law went into effect. And to me, again, that's a 50 times lower level than married filing jointly. 50 times. Okay, so again, we've talked about this. If the Build Back Act version 2 is passed, it would add this 5% surtax on for income in excess of 200 grand in a trust, and 8% if the income's over 500 grand. Okay, so again, I'm repeating, while at first blush, it seems like this wouldn't affect many clients. As a result of the Secure Act, now it will. See that? Because now you're going to have these big payments after the owner's death. Okay, and now we've already talked about the levels for the same level, comparable levels for individuals are 10 million and 25 million. Okay. So we've already mentioned this too. This surtax disparity is over and above the already significant disparity in the income tax treatment of trusts versus individuals. The comparable maximum tax brackets for individuals are now 40 to 50 times higher than trusts. And all you got to do is that should get your attention right away. Okay? So what do we do about it? Well, there's a lot of things you can do. One of them is you can avoid these high income tax rates on trusts by just paying the IRAs outright to the beneficiary. But again, this is what, again, I don't know if Congress is intentionally doing this, but this is the effect of their laws, is that they're kind of encouraging this activity because we don't want to pay those, we don't want our clients to pay these high trust income tax rates, so we'll just pay it outright. But what does it result in? It results in no estate tax, divorce, or lawsuit protection for the IRA, other than the portion of the IRA which has not been paid out yet. Obviously, you get some protection for that, but eventually, because of the 10-year rule, the IRA will most likely all be paid out, and you won't have any of these protections. Okay, all right. You can also avoid the high tax rates on trust by just paying the IRA to the trust. Okay, but having the trust every year just pay those amounts out, those receipts out to the beneficiary. So that's the old-fashioned conduit trust. Which, by the way, I always tell people in my 40-year career, I've never once ever drafted a conduit trust. Never once. And I have 5,000 clients. Never once. Because in my view, is you're just doing the client a disservice. There's a better way. So that's what we're talking about today. Okay. So again, the problem with these approaches that one way or another eventually give all the IRAs to the spouse or the kids. And I'm going to keep saying spouse, and you'll get the point in a little bit, because it results in no estate tax, divorce, or lawsuit protection other than for the portion which hasn't been distributed yet. So what can we do? So what I'm suggesting in this book and in this article I published today and in this webinar is to use section 678 of the code. And that's that book. In the book begins at pages 8 and 37. 8 is kind of the overview section. 37, page 37 is the section for lawyers, for estate planning attorneys. Okay. So this section provides, again, most of you are familiar with this. This section provides that a trust beneficiary who has the sole power to withdraw any portion of the income or principal of the trust is going to be taxed on that income, including capital gains, and the trust will not, regardless of whether the beneficiary actually receives that income. So 678, again, it's the sole power to withdraw, however you want to draft it, income or capital gains or both. And the beneficiary will be taxed, but you don't have to pay it to them. Why is that important? Because then the income that the beneficiary doesn't need stays in this trust, protected from estate taxes, divorce, and lawsuits. And lawsuits, by the way, that's in most, it's definitely protected from estate taxes, and we'll get into, and divorce. Lawsuits, most states it is, because the issue is, well, I'm not sure what you mean. Why is it protected? Because I have a right of withdrawal. Well, this next paragraph, we're going to get into the reasons for that, and that is because every year your power is going to lapse. And we'll get into this again on the next slide. In 2514E, it's going to lapse to the extent of 5% of the trust every year. And that's the maximum amount, as you know, that you can lapse without it being a taxable gift. Well, in most states, that lapse is not considered a transfer to the trust. And why would that be relevant? Because if it was a transfer to a trust for your own benefit, in many states, that would be subject to creditor attack. It's a self-settled trust. But most states have this law. And in my book, I referenced the summary of the states where you can find that. You have this law, and your own state may have it, that we will not treat this for state purposes as a transfer, potentially in fraud of creditor rights. Okay, so it's really that simple. And this is the way I explain it to clients. If you give your kids a right to withdraw or your spouse a right to withdraw, the spouse is taxed on that income at the individual rates. okay, and the individual surtax rates, and not at these outrageous trust income tax rates. Okay, so again, the way we draft it is pursuant to the terms of the trust. We give the power over the income elapsed as to 5% of the value of the trust every year. That's permitted under 2514E. That's so we were trying to minimize the amount of this trust which will be included in the beneficiary's taxable estate. So again, with the outright IRA approach, it's all includable. Okay, with this approach, what we want is maybe at most, by the time the beneficiary dies, at most 5% includable and 95% excludable. That's kind of the goal. And again, all that explanation, the forms are in my book. And there's a link in the book. And by the way, too, a lot of people don't like using links. You can also buy the book on Amazon. I charge the very minimum price Amazon permits. I think it's $12. Okay. I already mentioned in most states, the lapse would not be considered a transfer to trust for asset protection purposes. The lapse would also be would not be considered a gift, transfer for estate gift and generation skipping purposes. Retaining the assets in the trust, you guys already know this, helps better identify the trust assets for separate property purposes in the event of the trust beneficiary divorces. In other words, in most states, anything you receive by inheritance is your separate property, as you know, not subject to division in the divorce. The issue is, but you got to prove that. And in most states, it's presumed when you get divorced, everything you own is marital property, and you have to disprove it. Well, it's going to be much easier to disprove it if the assets have always been titled in the name of this trust in your parents' name. The trust is actually in your parents' name. Okay. Again, just to be clear, the unlapsed withdrawal rights remaining at the beneficiary's death are includable in the beneficiary's gross estate. So that's why we try to lapse them as to 5% every year, and so that by the time the beneficiary dies, there's very little. It's just your traditional hanging power that we use for crumbing trust. And so that by the time the beneficiary dies, there isn't much that's still outstanding in the way of withdrawal rights. How about, this is what I mentioned before, I'm going to talk about paying IRA benefits to a bypass trust for a spouse. Does that make sense? And I'm going to preface this now with the statement that up till now, I rarely paid, once the exemption got high, $5 and $11.7 million, I rarely paid IRA benefits to a bypass trust. It wasn't the income tax reason. It was more that the spouse, gets longer deferral, but not just that. When you pay IRAs outright to a spouse, that's when the kids, the children or grandchildren get to start that deferral all over again. Remember that? And they get you'll stretch IRA. So that was kind of the main reason as estate planning attorneys, we would pay it outright. We would rely on the portability election. Yeah, we understand we might be giving up generation skipping exemption of the IRA owners, but overall we think, well, gosh, yeah, but we get 30 or 40 years income tax deferral on that IRA. We'll take that trade. But now the maximum period is 5 or 10 years. And so now you start looking and go, okay, well, it's not quite as beneficial as it used to be to pay IRAs outright to a spouse. So given that, maybe I want to pay part of that IRA or part of the IRA to a bypass trust, which again, we never did before, rarely did before. But now you start thinking about it, well, if I can get generation skipping exemption by doing that, and I don't have to worry about the portability election and possibility of my spouse remarrying, and also I can protect all of those assets from lawsuits, that IRA from lawsuits, maybe I ought to start thinking about that. As long as I can draft it, that bypass trust in a way Jim mentioned with a 678 power to get the income tax at the spouse's rate and not at the high trust rate. You kind of getting all this? So you need to start thinking about that now, because the reason is because, most of us are not as bullish as we used to be on the estate tax exemption. We think it's going to sunset at $6 million in the year 2026, if not earlier, and could maybe even go lower. We're certainly not thinking that there's going to be a real large exemption or there's going to be a repeal. I mean, those things could happen, but we're certainly not planning on that. So you need to start thinking about paying all or part of the IRA to a trust. And there's another reason for that. And that is that if you pay all or part of the IRA to the trust, think what happens if you don't do that and the spouse just takes the minimum amount. Okay. Well, as you guys know, as the spouse gets older and older, I mean, two bad things are going to happen. number one, so you're maximizing your deferral, and so now this IRA is really building up. But as that spouse gets older, the RMDs go way up. You know that, right? They get to 8, 10, 12% as that spouse is older, and so those are going to be really big distributions because 8, 10, or 12% of a much larger amount. And remember, the spouse is likely to be single, so is using a single person's estate income tax brackets as opposed to a married, and basically single people are taxed at twice the rate of a married person. So what are you really doing? If I'm going for the maximum deferral, am I really accomplishing much? And now we got this huge pile of money when the spouse dies that's all now subject to the Secure Act, and the kids got to be taxed on over 5 or 10 years. So, so you start thinking about it and go, well, if I can't get this stretch IRA deferral anyway, and I understand what you're saying, Jim, about that, those RMDs are going to get really large, and if I just let the thing accumulate, the payment's going to be really large. Maybe I ought to be taking some money out of that IRA earlier. Well, once you've agreed with that, maybe I'll take some out earlier and roll it into a Roth or whatever. Then you start thinking about, well, maybe why don't I pay some of that? Why am I going to pay to a bypass trust? Because on top of it, I'll get the income out earlier, just the way I said I want to do. But while I'm at it, now I'm going to protect all the income from lawsuits and estate tax, okay, and generate and protect it for the generation skipping exemption. So, take your time and kind of think this through. But if you have a client that has, a 10 or $12 million estate, including IRAs, you want to start thinking about that as opposed to the old plan, which was kind of almost everyone, including myself, just paid it outright to the spouse. Because I said, I just think that stretch IRA deferral, 30 and 40 years kind of, and all the special rules for a spouse kind of trumps the potential of estate tax. So anyway, you get the point. We, in our practice, and again, it's not all or nothing. You can just say, I get it. Why do I do this? Why don't I pay half the IRA to the bypass trust and half outright to my spouse? And if you actually run all the math on that, what ends up happening is the average deferral period, for that IRA is kind of splits the difference, right? Half of it's at 10 years, half of it's at the spouse's period, which let's say the spouse's RMD period is 25 years. So half is each. So what am I really doing? I'm deferring it for, like 18 years. See that? And most people would say that's pretty good. And if you start thinking about it too, if your clients are already 72, you know that the deferral is much shorter. Now, again, in the rare cases, we'll have these younger clients that have a real big IRA. It's kind of rare because it takes a while to build up a big IRA. But if you have a younger client, that's kind of different. You'd say, well, I don't know if I want to pass up. My spouse is only 45 years old. Okay. I don't know if I want to pass up, 27 years deferral. That's a lot. So it's obviously math, but most clients that have accumulated larger IRAs are, getting in their 60s or 70s or maybe even older, and this kind of a plan makes sense. So again, what's the disadvantage of paying an IRA? The obvious one is you're causing earlier tax, and all I'm on the IRA, and all I'm saying is, but could this actually be an advantage? Could this actually turn out to be an advantage after the Secure Act? Okay, so again, it's factoring in the Secure Act, which included the various 5 and 10 year rules. I mentioned, especially for a surviving spouse who's already 72, so you don't get as much deferral. You get deferral, but not as much as if the spouse was only, say, 50. All right. Okay. And again, we mentioned the bypass trust would then be drafted to grant the surviving spouse's 678 withdrawal right. So the income would be taxed at the survivor's rate. But you're doing it without the obvious disadvantages associated with a conduit trust, which again, I've never drafted. Again, here's the reason, because a conduit trust, all those payments got to be made to the spouse. So now they're all in the spouse's estate. They're subject to lawsuits. They're subject to potential remarriage rights. You lose the generation skipping exemption on them, et cetera, et cetera. So you get the point. It's just worth thinking about. When we get down to the children and more remote descendants, again, we got the obvious same advantages as paying to a bypass trust, as far as income tax, and we get the divorce protection and lawsuit protection, okay? And remember, there's no longer a loss of income tax deferral, because assuming you draft the trust right, the deferral period's 10 years, whether you pay it outright to the child or pay it to a trust. You're not giving anything up, and there's no greater complexity, okay? And as most of you know, again, this isn't a speech on the Secure Act, but if you, for a special needs child, the trust for a special needs child still qualifies for a lifetime deferral. So finally, we get some benefit for a special needs child. I know we get like an exemption, a larger exemption than a regular trust doesn't get, but in my opinion, I don't even understand this. I don't understand why you're still, maybe you're getting longer deferral, but you're still subjecting that special needs child to the 37% tax rate and maybe higher with the Secure Act and the surtax. You're still subjecting them to that, plus state taxes. You got to be kidding me. So again, you can see why I'm so passionate about this. So the people in our society who need our help the best, we're potentially taxing them at 50%. Okay, so this is all relevant. It's about the way we draft it. At least we get the income. I could bore you with it, but it's in my book. There's ways to even get that income tax at different rates, and don't have time to maybe lower rates, but we don't have time to get into all that today. But overall, though, you guys already know this. In general, if you have a client with 3 children, including 1 special needs child, because of this lifetime provision, you may want to allocate the IRA larger to the special needs child, because the special needs child will get lifetime deferral. But again, it all depends upon overall tax brackets and stuff like that. It's all in the book. Disadvantages of 678 are that here's the big problem. You say, wait a minute, Jim. You said we're going to give the beneficiary a right to withdraw this income, including IRA receipts, potentially, and capital gains. Well, what if my kids are underage or they're otherwise immature? What if these beneficiaries get sued? What if they're in the middle of a divorce? Well, that's why I mentioned, and again, the book gets in this in more detail, is that we give the trustee the ability to suspend the beneficiary's power withdrawal before January 1 of the next year. I don't want to get into all the technical reasons for that. And you can also restore it later on. So this gives the trustee the control over these young kids. These kids say, hey, this is great. I have a right to withdraw all the income for the rest of my life. The heck with college, the heck with my job, I quit. Well, none of our clients want that. So the independent trustee, whether it's an uncle or whoever, when I say independent, it's not independent under the definition in Internal Revenue Code. I just mean someone who's not a beneficiary of the trust, because we don't want to have a conflict of interest here. That beneficiary, like an uncle, could suspend that right until that kid gets the act together, or until the lawsuit's over, or until the divorce proceedings are over. And again, explain much more detail in the book. Remember, I've been saying throughout this, what the beneficiary would have a right to withdraw the income. Well, there's a lot of ways you can draft that, but one of them is that you can say they have a right to withdraw all the income. So I want all the income withdrawal, because I want it all taxed at the beneficiary's rate. Well, what does income mean? Well, again, most of you know this is defined in the regulations, but in general, a trust document can define what receipts are income and what are principal. So if a trust document could say despite state law, a trust document could say all IRA receipts are income. It could say all capital gains are income. We don't do it that way, but it could do that. We like the optional way that the regs provide. It says the IRS authorizes the trustee to determine what receipts are income and what are principal, and the IRS will honor the trustee's determination as long as the trustee must determine the same in an impartial and reasonable manner. And we get into that in the book. What does that mean? So that's the way we do it, because that gives the trustee some ability, again, to modify this. So let's say in the middle of the year, there's a lawsuit against a beneficiary. Maybe we want to redefine income, the trustee, and lower that. Okay. And why would that be permissible from a fiduciary standpoint? Well, what's the trustee's primary duty to the beneficiary? Well, if the beneficiary is being sued and has this unilateral power to withdraw income, aren't you doing the beneficiary a disservice if you define income as basically everything? All IRA receipts, all capital gains. No, you'd be doing a disservice. So you pull back on that. And that's a very impartial and reasonable manner, because it's actually helping everyone in that trust by making sure that people can't get at that trust corpus. All right. So again, describe more in the book. We got about 20 minutes left, so I'll move fairly quickly, but I want to talk about some other points too. So again, you can define the scope of the beneficiary withdrawal right. Some people might say, well, why don't I do this, Jim? Why don't I just say income is just defined as amounts over $13,050? And that way I'll take advantage of the trust lower brackets. Well, I can tell you right away, you can run the math on that, but the advantage is only about $500. So you don't get a whole lot of advantage on that. And it's an awful lot of work coming up with that formulation, but you might get some advantage doing that. Very complex. So you got to look at the regulations under I cited them there 671-3 of the regs and see how all that would work. But there may be other reasons that are more significant. For example, you know that trusts can deduct trustees' fees, for example. Well, the individual can't. So that would be example. Let's say there's big corporate trustee fees. Well, maybe you want to keep a certain amount of income in to absorb those. And that can be done either by the definition of income in the document, the trustee's discretion, or by use of this full or partial use of the trustee's suspension power. In other words, suspend the beneficiary from the right of withdrawing up till, or just making this up till, let's say there's $20,000 of legal fees, trustee fees and legal fees. You can't withdraw the first 20 grand, just making that up. Okay, so now the beneficiary does not have that right to withdraw. So now that income is taxed under the regular trust rules. Well, trust would give you a deduction for those trustee and legal fees, whereas on an individual basis, at least right now, you wouldn't get those. And same thing goes for potential for local income tax and the SALT rules. Maybe you want to get maybe there's $20,000 total of deductions available, and the beneficiary has already used up his or her 10 grand ceiling for their own home, and maybe you want to use the other 10 grand for the trust is if there's another home in it. You get the idea. So there's a lot of flexibility built into these documents. I want to talk real briefly about, when you look at the book, there's other chapters in there, really not the purpose of today's presentation because it's more focused on trust drafting, but the first chapters of the book which are for your clients also get into other strategies for using for how to minimize taxes on IRAs. And so, but I can tell you one thing right away. Yeah, in the 75 articles I published in the 3 books, I have in all the presentations I've ever made, I've never said a word that somebody else has already said. So it's worth reading this because if you think that chapter is, oh, I already know how that works, like Roth conversions, read the chapter because I'm not going to say what you think. I'm going to make you think differently about a different way to look at things, not necessarily the right way, but a different way. Again, I wouldn't waste my time writing the book if I was just going to regurgitate what's already on the internet everywhere. Okay, so use of Roth IRAs and life insurance. I'm talking about, over time converting taxable IRAs to Roth IRAs, and I have a unique way of doing it, and it's called the retirement amortization plan. And again, without spending a lot of time on that, but basically you look at how much should I take out? I get what you're saying, Jim. I want to milk out more of my IRA than I would, and not just take the minimum, but how much should I take out? Well, under this retirement amortization plan outlined in the book, the goal is to take out roughly equal amounts over your and your spouse's remaining life expectancy plus 10 years. So the idea is that, so let's just say that worked out to 20 grand a year, or 20 grand a year. So you would take out 20 grand a year, and then your kids after your death would take out roughly, not exactly, but roughly 20 grand. And the idea is to smooth that income out so that in the long run, we pay a lot less income tax because we're not in high brackets. We're trying to smooth it out. We don't want some years when we're relatively low, but then some years when the income is really high, like the later R&D years, in the 80s, 90s, and now have a real high bracket. We don't want that. So the idea is that, and so mostly you do this when you advise clients to just when they retire. Why do I mean by that? Because in general, I don't think, at least I'm a CPA too. In general, it doesn't work out mathematically very well to do Roth conversions while you're still working and have a significant income. Because all you're doing is you're not only accelerating the income, but you're putting it into the high tax bracket years. You're still working. You want to wait till you're retired and you're in lower tax bracket years. So there's a chapter on that. Dueling approach to Roth conversions, that's basically what that's talking about. Okay, going back to the first one, I just want to mention too, when you take the money out of the IRA, it doesn't have to go into a Roth IRA. You could put it in other tax-free investments, including life insurance. And if you read that chapter, you'll see that I think the way it kind of works out better in most cases, kind of hedge your bets. And you put about half those IRA, I'm talking about the after-tax IRA distribution. You put about half of that in a Roth IRA and about half of that into second-to-die life insurance, assuming you're married, and put that in an ILA. So again, that chapter gets into what my reasons for that. But in general, that's kind of the to me, that's the approach that hedges your bets, because yeah, Roth IRA approaches work great if you assume you're going to live to life expectancy. But what if you don't? And you die much earlier than that. Now there's this huge IRA, right, that will be taxable to your kids. So the dueling approaches to the Roth conversions are, the traditional approach to Roth conversions was never convert more than would move you into a higher tax bracket. In other words, I'll take money out of my IRA and I'll convert it to my Roth, but I'm not going to take so much out that puts me into a higher tax bracket. I challenge that in the book. Okay. And the book shows both approaches. One, that's the traditional approach. I call that the pre-Secure Act approach. And the post-Secure Act approach would be more of this retirement amortization approach. And again, it's not an exact science. You don't have to use that exact approach, but you'll get the idea that if I actually am willing to move into a higher tax bracket, in the long run, myself and my spouse and my kids are going to be in a lower bracket. And I can't emphasize that spouse part enough, because you got to remember, if you die, there's two bad things as far as it's bad that you died, but two bad things for your spouse in addition, and are that number one, he or she's filing as a single taxpayer, so basically paying twice the taxes of a joint person. Okay, and he or she is likely to be older, and as you get older, your RMDs go way up. So the approach of only taking out enough that gets you to the next bracket, it means probably your IRA may never go down until you get much older. And so as a result, these payments to the spouse who's now filing single, okay, are going to be very large, and the taxes are going to be huge, way worse than the Secure Act, way worse than the 10 years. The penalty that have to go out 10 years for your kids, because of the combination of filing single and huge payments, which are going to be, you end up effectively being more than 1/10 of a year, as you get into your 80s, 90s. So it's not just this kind of planning discussed in the book. It's not just to save your kids' taxes, it's also to save the spouse taxes. And you got to look out for number one, in my opinion. Tax Smart IRA, all this is saying is that, again, it's all about tax brackets. If Congress is going to do this to us, and in general, try to make our kids take this money out over 10 years after that we die, why don't we at least be smart? And if you have a situation where a client has, let's say, 2 kids, and I always tell people, you could have 2 kids and the world's greatest kids, but for whatever reason, one's a doctor and one's a school teacher, okay? And they're both great, they're both smart, they're both doing great for the world, but the school teacher is going to be a lot lower tax bracket. So why would you pay your IRA equally? So let's say you had $2 million IRA and $2 million of other assets, okay? Why won't you think about paying all or some of the IRA to the school teacher and all or some of the other assets to the high tax bracket doctor? See what I'm getting at? And then the way we draft, we have a formula in our documents. I'm not sure it's in our forms, but it might be in our forms. We have a formula then that automatically, so there'll be a significant tax savings from that. And under our formula, we automatically allocate that tax savings to both kids. So if that plan says 100 grand, each kid is going to get 50 grand of that savings. So we don't want all the savings just to go to one in the lower bracket. And by the way, again, it's not an all or none. You may, in your particular case, it may work out better. Let's give 2/3 of the IRA to the school teacher and 1/3 to the doctor, just making it up. But it all depends upon all the facts. Obviously, you never do this when the kids are younger, because you have no idea what kind of tax bracket they're going to get. I'm talking about the kids are well into their 30s and 40s, and the parents can kind of look at that. And what we say, it has to be a dramatically different bracket. If they're, hey, I don't know exactly what they are, but maybe one's higher than the other one. That's not what I'm talking about. I'm talking about one where anyone can see one's in a much higher bracket than the other. Then you start doing that. And there's a whole chapter in the book on that. Last thing I want to mention, this is very important. And for you attorneys that have been out there a long time, that early on, like 40 years ago, we were doing a lot of what's called post-mortem tax planning, a lot of planning after a person dies, and you haven't heard much about it lately. But under the Secure Act, I think you should be doing that, because the reason is, I just give you a real simple example. Again, there's a whole chapter in the book on this. So the idea is that, okay, now first thing we do if our clients, husband and wife both die, is we sit the kids down, either in person or via Zoom or whatever, and we ask them, about how long is it going to be before you think you're going to retire? And why is that relevant? Well, it's pretty obvious, right? Because you do have to take the amounts out over 10 years, but you get to pick those years. So let's say one of the kids says, I think I'm going to retire in 2 years. Well, I would tell the kid, if I were you, I wouldn't take any money out of the IRA for 2 years, and then I would take 1/8 out a year. See that? Whereas the other child who says, I'm going to be working at least 10 years, and your better strategy might be take out 1/10 a year. Because why, again, is to get the lowest tax brackets. And lastly, the book gets into, a lot of you guys know that your income can affect your Medicare premiums. It can affect the amount of Social Security that's taxable. So in some cases, you might actually want to take those IRA distributions out early so you don't get into that situation. Another thing that the Internal Revenue Code kind of incentivizes you to basically take payments earlier when you have minor kids, because minor kids, while they're under 24, basically they can use a life expectancy payment system, and then after they attain the age, then they got to take out 10 years. And so a lot of people say, that's what I'll do. I'll defer everything. And most of it's going to come out then when they're 24. Well, what's the logical problem with that? Well, the problem is what you just did was defer the tax into the kids' working years. Okay. Now they're working and drawing a salary, and you deferred most of the IRA to those working years. Now they got to take it out and add it to their salary. Wouldn't have it actually been smarter, maybe in a lot of cases, to take that money earlier while the kids aren't working, like still in college or whatever, and have no income? So give that some thought. It's the old, the nice man comes up to the playground and offers the kids some candy from his car. Well, you don't necessarily walk in just because the person. So again, the IRS is kind of not intentionally, I'm not saying Congress is intentionally doing this, but it definitely kind of leads you down a path that actually results most of the time in the worst tax result. Right. Lastly, the book, I won't get into any names, but there's a whole chapter in the book that attempts to correct certain published misinformation regarding the income tax rules for trust. So there's one person out there who's not even a lawyer and writes article and book after book about why you would never pay IRAs to accumulation trust, because the author, again, not even a lawyer, and is giving estate planning advice, sure has never even heard of Section 678 of the code. So that's really bad. So the reason I keep that chapter in the book is that a lot of these people are, looking at that other person, advisor, for advice, and I want there to be a rebuttal. There's got to at least be a rebuttal. And I always tell people, it's not the unauthorized practice of law that bothers me. It's the malpractice of law. If you're going to practice law without a license, at least give people correct information. So that's why that chapter will always have that person's name in the chapter. Okay, because until that person stops doing it. Real quickly, on the last few points here. These are some of the things that have been proposed already this year. And the reason, again, I'm bringing them up is what I mentioned at the beginning. Hey, I'm not saying some of these couldn't resurface, because Joe Manchin's kind of implied maybe they might, because we're the Senate and we will do our own thing. Okay. And as you know, back in February and March, they had a lot of proposals. Eventually, those all got put into, not all, but some of those got put into the president's Green Book. I think that was in late March that came out. And you guys all remember the worst part about the Green Book proposals was a tax on built-in gains at death. There was an exemption, usually about $1 million of gain, but there was a tax on that. And so that went away in Build Back Better number 2. But it could resurface. I really doubt it, though. Okay, because I think that people like Joe Manchin are dead set against that, the capital gain area. But it's possible. Okay, and so you got to factor that in when you do your drafting and be aware of that. The first versions of this Build Back Better Act, all you're aware of, are dramatically different than version 2, but they eliminated valuation discounts for passive assets. So including passive assets owned in an active business. So in other words, if you have too much working capital in your business, then they might eliminate valuation discounts for that. So they didn't eliminate valuation discounts altogether. They're just saying you can't use valuation discounts for marketable securities. All right. It accelerated, the version 1 accelerated the $6 million exemption to January 1. and it imposed estate tax inclusions for grantor trust. And the way I explained this, I did a podcast about this yesterday. The way I try to explain this, and it's easier to understand, is remember the whole purpose of the grantor trust rules. They said, well, grantor, you have too much interest or control over this trust, so we're going to tax you on the income. And all the Congress is saying now, and Build Back version 1 is saying, well, why don't we use those same rules for estate tax purposes? We think you have too much control, so we're going to include it in your estate too. And by the way, the control is not just in you, but in your spouse. That's the kind of trap area. So that's why I wrote here, if ever passed, this effectively eliminates the ability to use a spousal access trust, because all spousal access trusts are grantor trust under IRC 673. Because of the addition of the spouse part of it. And I mentioned there, if this law ever gets passed, and I think it will someday, I really do, why don't you, one way you can deal with this is very clear on this Build Back Better Act version 1 that the IRS, the Internal Revenue Code portion rules, which are again in their 671-3 of their regulations, would apply. So if I drafted a trust and make it clear that my spouse only has an interest in 25% of it, then at most only 25% of the trust could be includable in my estate and 75% would be out. And for a lot of clients, they say, hey, that's pretty good. And so again, these are just a quick summary. Last points here. So we got inclusion. The Build Back Act version 1 also taxes sale or exchanges. So that's the main reason people use grantor trust, is that I can transfer highly appreciated assets to it. What's the bad thing about that? Well, normally that's carryover income tax basis, but because of it's a grantor trust, I'll just buy it back and maybe for a note or something, and now I'll get basis step up. So again, if that's too much control for income tax purposes under the grantor trust rules, Congress is now proposing that, well, that's too much control for estate tax purposes. See that? So again, right now, none of those provisions that we've been talking about are in version 2, but they could resurface. I doubt it, but I'm saying they could. Okay. A real important part is that the grantor trust rules, unlike the $6 million rule, they apply on the date President Biden would sign the bill. So that's why everyone was in a panic, the day before President Biden was going to go to Europe, because he was wanting to get this whole thing passed and signed before then. And so that if you were going to use the grantor trust, you had to do this. Problems for existing irrevocable trusts, again, most of you are aware of this, is that these proposed grantor trust rules would also apply if you had an existing trust but made future contributions to it. Okay, and again, that would be the portion rule. So let's say $100,000 was transferred before the effective date and $100,000 was transferred after. Well, maybe only 50% of the trust would be includable under 1.671-3. Okay, so there's ways around that. You can either pre-fund the trust, put money in before it. You can potentially, in some cases, you can potentially change the trust so it won't be a grantor trust. But again, that's difficult if you got a spousal access trust to use decanting to change the trust. But for a second to die trust, it can be. And what you say, what do you mean by that? All you got to do is, the real reason that these trusts are grantor trusts is 677 of the code. It says if you can use trust income to pay premiums, then it's a grantor trust. Well, just draft the trust so you can't use trust income. And by the way, no one knows what 670 means by the term income. So what we do in our forms, we say you can't use trust income as that term is used for purposes of IRC 677. So again, we don't really know for sure what they mean. Does it include accumulated income, et cetera? So we just make it really clear. However, whatever that term means for 677 purposes, you don't do it. And then you also want to make sure you eliminate a power to substitute in the trust. Again, this is second to die trust. So second to die life trusts are pretty easy to get around it. Okay. Last thing I want to mention is that, you'll have some clients that it's impossible to pre-fund it because of the company pays the premiums. Okay, it's the company pay premium. So those are going to be additional contributions. If you have a clause in your trust document, like most of us do, it has this protective clause and it says no one shall have a power or interest in the trust which would cause the trust to be includable in the grantor's or the grantor spouse's estate. Then by definition, what happens then is that the trust won't be includable Okay, it's just that if the spouse is a beneficiary of the spouse may end up not being a beneficiary of the whole thing. So I gave that example. If half the premiums are paid by the company after the policy has been after the effective date of the law and the policy has already been transferred to the trust, and now company pays premiums, then in that example, the whole trust would be excludable, but the spouse would only have an interest in 50%. Again, I can't spend a lot of time on that, but that's just my analysis if you use these protective clauses, which we all do. Lastly, estate protection. One other point I want to make about this. Many trusts, again, include these safe harbor clauses. You got to look at your own document to see how that safe harbor clause would work. But ours works the way I just told you. It basically eliminates interest in a spouse to the extent it would cause inclusion. Again, this is a potential negative. And what part would be includable, in my opinion? Again, the Build Back Better Act specifically uses these portion rule analogies. And so that means you'd look at 671-3 of the code to figure out what portion are you talking about. Oh, I did one slide here. Yeah, I just want to mention that the proposed laws would apply if additional contributions are made to grandfather trust. So just be careful how you structure a future irrevocable trust to recognize that. So you could be setting one up today and say, oh, well, this law doesn't apply, but you also know that there may be future premiums. So you structure the trust assuming there would be future contributions, and everything we just talked about would be the way you draft it. So I just gave you an example. Maybe the draft the trust so you can't use trust income to pay premiums. Last thing I want to mention, if this law does come in and you want to, or even if it doesn't, and a client wants to make a large transfer to the trust, but wants to retain access to it and understands that if I use my exemption for my wife and my wife uses her exemption for me, that could be the reciprocal trust doctrine. And by the way, I don't think there's any way to completely avoid it. If you read I've written a lot of articles on that too. But it's not what people think. You can't just make them a little bit different and you avoided them. So there's a concept called the double spousal access trust. And I wrote an article on that last November, and it's published in WealthCounsel. And I think it's in the link to that is in your materials, where you can look at so the example today was, how could the husband put maybe $23 million in a trust, a spousal access trust for his wife, and have it go on to the kids, and have it treated as though the wife gave half of that. Most people would think, well, you can't do that because you can't gift split on a gift to a spouse, but actually you can if you use the techniques outlined in that article. We do it a lot, okay? So take a look at that article. Let me know if you have any questions, okay? And I don't know if you have any time for questions. It's 1 o'clock.
It is. We do want to cover a couple of questions real quickly. Anyone who needs to jump off, can we move forward to the next couple of slides? I wanted to show the attendance verification code for anyone who can't stay for a couple of questions. So Jim, go ahead and scoot to I guess one more past that. There's a slide here with the CLE information. We have the CLE attendance code. This is for extra verification if you need it. Do not send this to us if you have attended live. And this is not a CLE course number. And that number is lowercase j 2978. And if you have any questions on CLE, including about your certificate, which will be sent in a few weeks, you can email cle@wealthcounsel.com. And any other information about WealthCounsel can be found at our 888-659-4069 extension 819 number, or you can visit us at wealthcounsel.com. So thank you all for attending, and a couple of questions we can answer hopefully quickly. Could the beneficiary be forced to exercise the 5 and 5 power each year and give it to the divorced spouse?
Potentially, but that's why we have this power to suspend in there. So the trustee would suspend the beneficiary's power. So they may have a power for a period of months during it. The other thing we said about, remember, what is your power? I want to make this clear. You don't have a power. You do not have a power to withdraw 5% of the trust. What you have is a power to withdraw the income of the trust, and the trustee determines what the income is. Okay, so basically, the income can be determined to be pretty low, and yeah, you'll have a power to force the withdrawal of that part of the income, but that's it. All the principal would be protected.
Thank you. Next question, to clarify, to minimize the beneficiary's access to the IRA with trust named as DB, the IRA still has to be paid out to the beneficiary over 10 years. And would the subtrust need to be a conduit, or can it be an accumulation as long as the IRA is paid out over 10 years?
Yeah, that's the trust payments are to the IRA payments are to the trust, and that would be in my drafting an accumulation trust. So that's the whole point, is that the reason I said I've never used a conduit trust my entire 40 years is that does force all the payments out, okay, to the person, and then it's all subject to estate tax, lawsuits, and divorce rights. And I just don't think you need to do that if you use section 678. So the payments are to the trust, but they're not forced out to the beneficiary. They stay in the trust, protected from estate taxes, lawsuits, and divorce.
Great, thank you. We'll take one more question. Will the 5% power be sufficient to include all of the distributions in the beneficiary's personal income if the distributions exceed 5% of the trust assets?
That's a good question. That's a good question. So to clarify again, it's not a 5% power. Your power is to withdraw all of the income of the trust, at least the way we draft it. You can limit it if you want, but ours say all of the income. The 5% has to do with the lapsing. So it's like a crummy power. So let's say, I'll give you an example. The 5% equals 200 grand, and the trust is worth 2 million. Okay. So what's the math on that? 100 grand, right? So 5% of your 200 grand, right, would lapse. Okay. And that's 5% of 2 million. It's of the trust. And so 100 grand would lapse. 100 grand would hang, like under your traditional hanging powers, which you probably have in your life insurance trust. So 100 grand would hang, subject to continual 5% lapsing every year. So another example would be, let's say the power withdrawal was 100 grand. Okay. The income was 100 grand and the trust was worth 2 million. Okay. Well, 5% of 2 million is 100 grand. So in that fact situation, the entire right of withdrawal would lapse every year. Okay. So again, it's not, you don't have a right to withdraw 5%. You have a right to withdraw the income. That may be more or less than 5%. The 5% is just how much of your right lapses every year. And it's not 5% of the right. It's an amount equal to 5% of the value of the trust at the end of the year. And you'll see in our book, by the way, too, we define value of the trust to include all IRAs, 401ks, which are payable to the trust. In other words, the trustee can use any of those assets, including stuff that hasn't even been paid yet, to satisfy your right of withdrawal. And that's all because if you read 2514E closely, that's what it looks at. It looks at the issue is 5% of what? Well, it's 5% of the assets out of which the trustee could satisfy the withdrawal right. And so we want to make that pot as large as possible. So we say the trustee, you can use IRAs that haven't even been paid out yet to the trust. You can use those too. Okay. So that broadens the 5%.
Thank you, Jim. And please move one slide forward. Share the power of this thought leadership through Twitter or Facebook and use the hashtag attorney education to share this with other colleagues in your network. We will provide the materials on the Event Hub and also on the WealthCounsel member website for members. And the recording is available in both places within approximately 24 business hours. And let's move to the next slide with the CLE information again, so you can see that one more time. And also at the very top, if you'd be interested in joining WealthCounsel's open community group, you can go to that link, member.wealthcounsel.com/community-signup. Thank you all for joining us today, and a huge thank you to Jim for sharing his expertise with us.
I just want to say thank you again to the audience, because I really thoroughly enjoyed just trying to get this word out. And I tell people, if any of you have ever attended the Salvation Army annual program, what I feel really good about is 5 years ago, they were saying nothing about this. At the program last September, they were talking about this as like, this is just the way you should do it. So I really feel good, because just trying to get the word out. Again, no one has to do it my way. I just want to make sure people are aware of these options.
Have a great day.
Thank you all.